This is Duke University.
We launched Glenfarne with a very simple thesis. Infrastructure is a huge business area or business model that if you pick the right places, you can act as an entrepreneur. Typically in infrastructure, there's a mindset, it's not really an entrepreneurial sector. Do you build a $1 billion toll road as an entrepreneur or buy a multi-billion dollar gas company? We took the approach that putting small amounts of money out the door early on in the business, we could develop new projects and new companies from scratch and then use that to build a company around. And we've been relatively successful in that, and as of today we've launched 3 specialist companies. Primena here that does backup capacity power provision to the grid, and that's growing at a great pace. We've set up another company, Fontis Hydro, that is an owner-operator of run-of-river hydro projects, generally smaller projects, 20 megawatts or less, and we're about to make our first investment in that sector. And then we've launched a business called Integrated Fibre that is especially in biomass power, but with a twist where there is a co-location with a wood or forest product industrial operation, and we own the whole business. And the first project for that is located in Tallahassee, Florida. Where's the sort of innovation in finance? One area that we're operating in sort of infrastructure innovation, and we see it in renewable energy in North America, and a lot of new ideas where the scale of investment per location is small. And so we've seen the business models of the rooftop solar, and everyone can build them, everyone can install them, but how do you originate new rooftops and how do you finance them on a system-wide basis? And the solar cities and the various outfits have sort of cracked this model. But we've looked at how do we do it for more mid-size assets, and for us in infrastructure, a true infrastructure asset, in my opinion, is typically a $500 million asset or above, just so you've got enough critical revenue and EBITDA that you can deal with personnel changes and whatnot without it changing EBITDA. We're looking at assets that are $50 million, and we put 10 of them together and they're a $500 million business. And when we do that, it allows us to go from a local banking relationship where the family in Chile had to put a personal guarantee on the loan and it was repaid over 5 years and it had a high interest rate. We can put a New York financing on and we can get long-term debt, low levels of amortization with very low interest rates, and we can originate those assets on a system-wide basis that the acquisition cost is acceptable and reasonable. So that's one area we're operating. The other area is, and we're seeing it through all of the infrastructure investors, is getting further back up the value chain down to the development level. So when we started out at Macquarie, everyone said we just want to own operating assets, but now everyone, including the most risk adverse, is saying I've got to get close to the development because it's the only way to get some differentiation between cost and value. I think one of the things to point out in infrastructure, if you're sort of going into the finance side of it, and I'll do a comparison to, say, private equity or hedge funds. In hedge funds, there's a lot less personal interaction with the outside world. You've got your trading strategy. You can work hard and you can work all night and sleep all day, and your strategy may work. I'm generalizing. I'm not in hedge funds. In private equity, it's making bigger calls and your ability to influence management as an investor over time. And you can have a private equity strategy that bumps around for a couple of years and then eventually you replace the CEO and it takes off. In infrastructure, everything you do and all of your magic happens the day you make the decision to buy it. Because a true infrastructure asset that's a long-term toll road concession, you can't do that much to influence how people come on the road. And so up front, it's huge contract analysis, huge contract negotiation, and super detailed financial modelling. So what we find in infrastructure is that the modelling capabilities and the volume of scenarios you run swamps the private equity version of it 100-fold. The other thing is to come up with that innovative financing and the right terms and conditions in the contract. You have to spend a lot of time just thinking about how to do it. And so I find that the hours slaving over a contract or a financial model when you're young, usually it's first the financial model, and then when you get a little bit older it's the contract, just takes a lot of hours, and you have to love looking at 1 or 2 basis points of an IRR. And if you don't love that and you're not willing to work those long hours, it's very hard to be successful.